Hello, Mark Lloyd, Leader Home Loans. This is part 4 of debt to income. Is the debt to income ratio a good indicator of financial health? It's probably clear by now that the debt to income ratio is not a proxy for household cash flow. By excluding broad expense categories such as utilities, insurance, and food, debt to income is at best an incomplete picture of your overall financial health. Though it's easier to spend more than you earn with a wallet full of credit cards or a vast portfolio of personal loans, excessive leverage isn't the only factor that can compromise your financial resilience. Debt to income is a good indicator of personal creditworthiness, if only due to the degree of which lenders rely on it in underwriting decisions. But your out-of-the-box debt to income ratio defined in the previous videos isn't enough to produce a holistic picture of your financial well-being. To achieve that, you need to redefine debt. How to calculate a personal debt to income ratio. Your personalized debt to income ratio should account for reoccurring, unavoidable personal or family expenses not included in the previous steps about debt. Such expenses might include health insurance, auto insurance, house insurance, if not bundled in the escrow, childcare costs if you have young kids in a single parent or two-earner household, income taxes if not wholly withheld from your paycheck, utility and communication expenses, groceries. Obviously, the more expenses you include, the closer you'll come up to simply rehashing your household budget. If you don't already have a household budget, read up on how to make a personal budget for the first time. You can avoid that by concentrating on largest obligations in most cases, health insurance and childcare. Before calculating your personalized debt to income ratio, subtract your house insurance costs and childcare costs, if applicable, from your gross income. If you qualify for tax credits or deductions related to either expense, add those back in. Depending on your income, you may qualify for a tax credit equal to 20% to 35% of qualifying daycare or other supervisory expenses for children and dependents under the age of 13, capped at 3% in expenses for one child and $6,000 expenses for 2 or more children. The full credit is only available for low-income parents. If you earn more than $43,000 per year, your credit is capped at 20%. This threshold is subject to change each tax year, so refer to your most recent tax return and current IRS publication before making any assumptions about your eligibility. Calculating your debt to income ratio. An example. Say your share of your health insurance plan costs you $2,500 per year. Your child care expenses total $11,000 per year for 2 children, and your gross annual income is $70,000. Assuming your children qualify for the child and dependent care tax credit, you'll be able to claim $2,200. To find your true income basis for a personalized debt to income calculation, you'd subtract $13,500 from $70,000, then add back $2,200, $58,700 annual income, or approximately $4,892 per month. You can use this income basis to determine your maximum recommended debt load. Based on lenders' debt to income thresholds, if you're applying for a mortgage and want to be sure you qualify for the best possible rates and terms for your credit profile, shoot for no more than 36% debt to income ratio. At a monthly income basis of $4,892, without accounting for any additional expenses, you can afford to spend no more than $1,761 per month on debt service. Tomorrow I'll discuss tips on how to improve your debt to income ratio. As always, you can reach out to me at www.talkwithmarklloyd.com. Call or text 207-478-2065. Thank you.